When people talk about property investing, they usually think about buying houses. But some of the most reliable property income in the UK doesn't come from houses at all. It comes from places you walk past every day. Warehouses that deliver your Amazon parcels, GP surgeries you visit when you're sick, retail parks, your Superdrug, Tesco, and B&Q. You can own these buildings through REIT stocks. In this video, I'm breaking down 8 UK real estate investment trusts, ranking them from the least reliable to the most reliable. So by the end, you will understand exactly which ones actually make sense for dividend income and which ones to avoid. At the end, I'll show you the key things I personally look for when choosing REITs. A REIT, or Real Estate Investment Trust, is a company that owns property and collects rent. Instead of relying on one tenant, you're investing in a diversified portfolio of buildings. By law, UK REITs must pay out most of their profits to shareholders. That's why REITs can be powerful income tools, but high yield doesn't always mean safe income. And after several difficult years for property, REITs are starting to look interesting again. With that in mind, let's start at the bottom. British Land, ticker BLND. British Land is one of the UK's largest and oldest property companies, operating since 1856. It owns a portfolio of London office buildings and prime retail properties, large recognizable assets in major cities, typically leased to corporate tenants and established retailers. The business generates cash by leasing this space on multi-year contracts and collecting rent. On paper, this can look like a strong income model, but the problem is how predictable that rent is going forward. Office demand has changed significantly since the pandemic, which puts pressure on future rental income. The dividend yield is currently around 5.6%. British Land does have diversification and relatively high occupancy, which gives it some resilience, but it still carries significant office and retail risk. So I'll score British Land a 5 out of 10. Next is Land Securities. Land Securities is one of the largest property owners in the UK, historically focused on London offices and prime retail. You've almost certainly been inside a Land Securities property at some point without realizing it. The company has started pivoting away from some office exposure and toward retail destinations and residential developments, but a meaningful portion of cash flow is still tied to offices, which remains cyclical. The dividend yield is currently around 6.1%, and dividends are now paid half yearly rather than quarterly. The payout ratio sits at roughly 122%, which immediately raises eyebrows. That means the company is paying out more than it earns in the short term. However, REIT accounting can distort earnings due to property revaluations, but it's still something to monitor. If UK office and retail conditions improve as expected over the next few months, there's upside here. But this is still economically sensitive income, not defensive income. So as a dividend REIT, I'll score it a 6 out of 10. Next up is Custodian Property Income REIT. Custodian focuses on smaller commercial properties across the UK, including local retail warehouses, offices, and regional business premises. Cash flow comes from a wide spread of tenants, which reduces reliance on any single property or sector. The company pays dividends quarterly and currently yields around 6.9%. The main risk is that smaller properties can be harder to relet in weak markets. But overall, the income profile here is much cleaner than office-heavy REITs. With a long history of stable or growing payouts and a diversified regional portfolio, Custodian is a classic steady income REIT. As a dividend holding, I'll score it a 7 out of 10. Now, let's look at LondonMetric Property. LondonMetric is a diversified REIT with a portfolio that includes logistics warehouses, retail parks, convenience-led retail, and long lease properties. These are practical, everyday buildings used by supermarkets, logistics firms, and national chains. Cash flow comes from long-term leases with strong tenants, often with built-in annual rent increases. LondonMetric's dividend track record is particularly attractive. It has raised its annual dividend for 10 consecutive years, including a 17.6% increase last year. The dividend yield is currently around 6%. The main risk is that despite its diversification, LondonMetric still has exposure to retail and broader economic conditions, which are tied to consumer spending. If retail demand weakens, rent growth could slow. As a balance between yield and reliability, LondonMetric sits in a very strong middle ground. So as a dividend REIT, I'll score it an 8 out of 10. Now, let's look at Target Healthcare REIT. Target Healthcare is a specialist healthcare REIT invested in modern, purpose-built UK care homes let on long leases to care home operators. Demand here is driven by demographics, an aging population, and rising demand for long-term care. Rental cash flow is generated through long leases, often with inflation-linked rent increases, which makes income far more predictable than office or retail-focused REITs. The company pays dividends quarterly and currently yields around 5.7%. Dividend sustainability is strong because income is backed by contracted rent rather than discretionary spending. The main risk to be aware of is operator health. Care providers need to remain financially stable for rent to keep flowing. Because of that operator risk, this doesn't quite score higher, but for defensive, needs-based property exposure, it's very compelling. I'll score Target Healthcare an 8.5 out of 10. Next is Tritax Big Box. Tritax is a specialist logistics REIT that owns large distribution warehouses typically located near major motorways. These are the distribution centers used by supermarkets, logistics firms, and major retailers to store and distribute goods around the country. Cash flow here is highly predictable. Leases are long, tenants invest heavily in the sites, and relocation costs are high, which keeps occupancy strong. The dividend yield is currently around 4.7%. The main risk is tenant concentration. Most Tritax warehouses are often leased to one major tenant, so while lease lengths are long, if a tenant ever leaves, reletting can take time. With strong demand for logistics space and visible rental demand, Tritax is a classic core logistics REIT, so I'll score it an 8.5 out of 10. Primary Health Properties is a healthcare REIT that owns GP surgeries and primary care medical centers, mainly in the UK, with some assets in Ireland. These buildings are often leased directly or indirectly to the NHS. People don't stop needing healthcare in a recession, which makes cash flow very predictable. Income comes from long leases, very low tenant turnover, and often inflation-linked rent. PHP pays dividend quarterly and currently yields around 7.1%. This is one of the cleanest income stories in the UK REIT space. The key risk is government funding. Because rental income is tied to public healthcare budgets, long-term rent growth depends on NHS funding decisions. For investors seeking defensive government-linked income, PHP is very hard to beat. As a dividend REIT, I'll score it a 9 out of 10. Finally, Segro. Segro owns warehouses and logistics hubs across the UK and Europe. It focuses on urban logistics and supply-constrained locations with tenants like Amazon and other major operators. If you've ever had next-day delivery, there's a good chance it passed through a Segro-owned warehouse. Cash flow comes from long leases with high-quality tenants and low vacancy rates. The dividend yield is lower than most on this list, currently around 4%, because Segro reinvests heavily to grow, which makes its dividend extremely durable. The main risk here is valuation. Segro is widely seen as best in class, so expectations are high, and even small disappointments can impact the share price. For long-term dividend reliability, Segro remains the benchmark. As a dividend REIT, Segro scores a 9.5 out of 10. If you want to build a diversified REIT basket, the goal isn't to find one perfect stock. It's to blend different property types so your income isn't reliant on a single economic driver. Combining logistics like Tritax and Segro, diversified commercial names like LondonMetric and Custodian, and healthcare REITs like Target Healthcare and Primary Health Properties spreads risk across different economic environments. Before investing in any REIT, I focus on 3 things: balance sheet strength, dividend coverage, and occupancy with positive rental growth. But remember, property is cyclical and REIT share prices can be volatile, so diversification and position sizing still matter. So, those are 8 UK REITs to buy. If you found this helpful and want more UK-focused dividend ideas, make sure you subscribe and turn on notifications so you don't miss the next video. Comment below with which REIT you already own or which one you're adding to your watch list. And don't forget to tap the like button. Thanks for watching, and I'll see you in the next one.